Hello, everyone. My name is Deepak, and I'm a tax code advisor. Depreciation recapture. So, very tricky word, but those of us who are real estate investors, I'm one of those. We are probably familiar with it. And if we are not, we should become familiar with it because sooner or later we are going to deal with this depreciation recapture. So, before I talk more about that, let's start with what is depreciation. Does it help us? Does it hurt us? What if we don't take it? What else can we do with the depreciation? Can it help us build better wealth? Let's tackle all of those and then we'll get a little bit deeper into what do I mean by depreciation recapture. So, what is depreciation to begin with? IRS allows us to put different assets, different buckets, and those buckets get a useful life. For example, if I buy a residential property, the useful life of that property would be 27 and a half years. Now, I know you are thinking, well, that's not true. I have a house that is 100-year-old and still, in place. And I get that. So that's not the point here. The point is we have to pick one number. In the tax code for residential properties, we got 27 and a half years. For commercial properties, we have 39 years. Similarly, we have other things that we have in our home. For example, we might have appliances, we might have air conditioning unit, we might have a heater, we might have a roof. Each one of these assets have a different lifespan as far as IRS is concerned. So for each asset, you get to depreciate it over that time frame. So let's just say in the case of residential property, where IRS says, hey, you can depreciate it over 27 and a half years. So let's just say if I buy a property for about $1 million and I maybe $100 is my land value, maybe $900,000. 100,000 is my land value, and $900,000 is my land improvement. Maybe I built a building on it. That is going to result in roughly about $32,000 in depreciation. Very simple math. I took $900,000 divided by 27 and a half years, right? So roughly about $32,700 per year. That's the number you get. What that means is that if you put that property on rent and you are generating an income of, let's say, $32,000 and you have a depreciation of $32,700, that means you are in a loss. You have created a paper loss. You don't pay any tax whatsoever on that $32,000 income. Now, what's interesting about that is that $2,000 actually came to your bank account. It's available to you. You can use that money to buy another property. You can use that money to buy stocks. You can use that money to go out on vacation. You can do whatever you want to do with it. And you did not pay any tax on it whatsoever. So let's see if you are in a 37% tax bracket. You save 37% on that $32,000. If you're in 25% tax bracket, that's what your saving is. If you're in a lower tax bracket, so the higher tax bracket you are in, the more beneficial this whole concept of depreciation for you because you're not paying any tax on it. But why does the depreciation exist to begin with? Why even have it? Well, maybe we can get away with it, maybe we just don't need it. So the idea is you actually do need it. Why do you need it? Let's say you bought an appliance. Let's say you bought a refrigerator for your rental property. And the useful life of that refrigerator is 5 years. Maybe you spend, $5,000 on that refrigerator. That means you get to depreciate it over 5 years, $1,000 each year for the next 5 years. That's the depreciation. Now, what if that refrigerator just goes out in 2 years, right? So you only took $2,000 in deduction so far. But now, because that refrigerator is gone, in the third year, when that refrigerator is no good, you get to claim the other 3,000. Similarly, that can happen to your roof, that can happen to your AC, that can happen to a lot of your other equipments. And I'm bringing this up because many times when clients own investment properties, they're not tracking any of this. Why? Because they're not really having a proper conversation with their tax professional and discuss these subject matters. Because these things only pop up when you're sitting and discussing about your business, not about how to file your taxes. So depreciation allows us to kind of deal with all these different kind of scenarios. We get to take deductions and we move on because we save a lot of money on taxes with that. The problem happens when we are ready to sell the property. And all of a sudden, we go to our tax accountant and we find out that we have to recapture all this depreciation that we have been taking for last 20 years. And on top of that, they might say, well, this depreciation will be taxed at this rate. And all of a sudden, that just doesn't sound good. But trust me, it's not bad. Let me explain you the math. First of all, when we talk about recapturing the depreciation, there are three different types of depreciation recapture. Number one is what we call 1245 depreciation. And 1245 basically refers to your personal property. For example, I talked about appliances, as something else that you might have in house that you are depreciating and you're using it for your investment property. For example, maybe you have furniture because you are running an Airbnb. Maybe you have other things in your house. So anything that is personal property. If that personal property is sold and we have taken some depreciation on it, then we will have to recapture that. That's number one. The 1245 depreciation recapture is done at the ordinary income rate. So there's not much you can do. If you sell it, you have to get that because you're getting paid for that. So you need to give that tax benefit back to the government. Second kind of depreciation happens on what we call bonus depreciation. So let's say you have a land, you built a house, and you have all bunch of stuff in it, and you take a bonus depreciation on it. So what I mean by bonus depreciation is just to make the math simple. Let's say property was supposed to be depreciated over 15 years, and you were supposed to take a deduction for $10,000 each year. That means $150,000 over the next 15 years. And let's say 5 years down the road, you sell that property. That means you have taken, you took the bonus depreciation, you took all of that $150,000 in depreciation on day one, but 5 years later, you're actually selling it, right? So that means, technically speaking, you were entitled to only $50,000 worth of depreciation, 10,000 times 5 years, but you took the bonus depreciation and took the entire 15 years up front. That means you have this bonus extra depreciation of roughly $100,000. Now you got to pay that depreciation back. And lastly, which most commonly known as what we call 1250 gain. That's the third type of depreciation. And 1250 gain is taxed at 25%. And this is simply means that you have doing a straight line depreciation. So like I said, let's say if you have $1 million property, you depreciate it over 27 and a half years, $100,000 was your land value. So you took that $900,000 divided over 27 and a half years, and you were taking depreciations of 32,700 every single year. Now, let's say you took that depreciation for 2 years and you sell the property. So now you have to recapture that 32,000 times 2 because you took it for 2 years, and you pay 25% tax on that. So that's the 1250 gain. That's the most common depreciation that people are talking about. However, I just wanted to clarify that that's not the only depreciation. You might have other things in the puzzle as well. So that's the reason why we have to recapture, because you took those benefits in advance. Let's stick with that for a second. Should we take bonus depreciation? Well, why not? Because if you take a bonus depreciation, you get to have a better tax deduction today. And because you have better tax deduction, you have more money available to you, and you can use that money to go invest in other things. You can buy more stocks with it. You can buy a real estate with it. You can invest in your business. You can do whatever you want to do with that money. It's available to you. So if you can invest it better, then that's great. Take advantage of that. And who knows if you are going to actually even sell that property or not, right? Maybe you might not even sell it 5 years, 10 years, 20 years down the road. And even if you do sell it, maybe you do 1031 exchange. You don't just make a regular sale. So who knows what will happen in the future? I don't want to make my decisions based on what I think might happen in the future. I want to plan, what will be the most efficient strategy for me? What can save me money? Worst case, let's say if I save $5,000 today and I have to pay that $5,000 back 10 years from now, who cares? I get to use that $5,000 for the next 10 years, right? Not a bad deal. So it's okay. So now that we got that depreciation out of the way, let's talk about what if you just don't want to take the depreciation? What if you want to ignore it altogether. You say, look, it's too complicated. I don't mess around with it. What if I just don't take it at all? So here's a problem with that. Depreciation are use it or lose it type of a deal. Meaning, if you don't use it, and when you sell that property, you would still have to recapture that depreciation. So it's in your best interest to timely depreciate the property and take advantage of all those tax benefits that are available to you. And like I said earlier, right? So let's say if you're in a higher tax bracket, let's say if you're in a 37% tax bracket, if there was no depreciation, then you'll be paying 37% tax on that income. But because you use depreciation and you get to use that tax-free money for next 5-10 years until you sell that property. But even when you sell the property, your maximum tax on that depreciation recapture will only be 25%. So even then, you're actually coming out ahead, even if you decide not to use the depreciation. But it's in the law. You're required to take depreciation. So don't ignore it. Now, what if you forgot, or maybe somebody gave you wrong advice, or maybe somebody just told you, don't worry about it. It's okay. You don't have to take depreciation. Maybe you watch some influencer online who suggested, hey, don't mess with it. Whatever. So one reason or the other, you just didn't take the depreciation. In that case, what happens? Okay, so I'll offer you a couple of solutions in that case. Number one solution is if the investment property was placed in service a few years ago, maybe 2 years ago, maybe 3 years ago, then the easier solution would be is to amend your tax returns. We're happy to do that for you, or whoever work on your taxes. You can talk to them and they can help you amend that tax return. If you did it yourself, then I'll strongly recommend that you go to a tax professional and let them properly amend it for you and claim that depreciation. That's your one option. And you can, like I said, you can go back up to 3 years, so you can fix that. But if it's, 5-year-old, 7 years old, then that becomes a little bit of a trouble. Second solution I can potentially offer you is you can file the Form 3115. Form 3115 allows you to go back in time and capture that depreciation. So that's your another option. And lastly, if you are selling a property this year, or if you're not planning on selling the property and you haven't been claiming a depreciation, then one of the options is you do that Form 3115 strategy in the year that you actually sell the property, because that's the year when that recaptured depreciation will be due. And that's the year you should be go back in time and claim all your pending depreciation. So that way it kind of balances out. The problem I have with 3115 is that it's a complicated tax form. A lot of tax professionals don't even know how to do it. We can help you out if you need it, but it's a complicated thing to do. So if you can avoid it, avoid it. If you can just amend your tax returns, it's just a lot easier. If you can capture the depreciation at the right time, that's just a whole lot better. Right? So 3115 is an option, but not recommended. And on a related topic, we go back a little bit and say, look, let's say if I have a property, I have been taking depreciation on it for many, many years. And now 20 years down the road, 30 years down the road, what should I do with it? Well, one of the strategies could be is you just simply do a 1031 exchange. And a new property, you can generate more paper losses by doing cost segregation. And maybe bonus depreciation is available that year. So there might be some strategies around that can allow you to offset some of this depreciation recapture. That could be one option. Then you have opportunity zones that you might be able to use as an opportunity. I think next year, 2025, I'm recording this in 24. So that sort of expires in 2025 unless that get extended. So that might not be as beneficial at this point. But hey, we still got another year. And then there are a lot of other strategies out there to kind of defer those capital gains or deal with them one way or the other. So if you have to deal with it, then come talk to us and we'll find you a way to deal with that. So some of the takeaways from this, number one, depreciation is not optional. It's required. If you use it, great. If you don't use it, you will still have to recapture the depreciation. In most cases, we are talking about Section 1250 gain. That means that depreciation recapture will be taxed at 25%. And 25% is not a bad number, so don't get scared. Most of us are probably in a roughly 25% tax bracket. Many of us might be even more than that. So if you are more than 25%, then this is a great deal for you. If you're in 25% tax deal, it's an average deal for you. And if you happen to be in the lower tax bracket, then maybe it's not as good of a deal. But that's what it is. We don't win all the time. So that's keep that in mind. And like I said, if you need to avoid dealing with these taxes, then some of the options available to you is 1031 exchange, cost segregation, creating large paper losses, opportunity zones, and some of the other strategies that we might have available to deal with it. So that's how the cost segregation works in general. If you have a specific question, you want us to run some numbers, you want to set up a consultation, you own an investment property, then please set up an appointment with us, and we are happy to work together. We have a lot of short-term rental owners who work with us. We have a lot of long-term rental owners. I own investment properties, so we are very much familiar with this matter and can definitely help you out. So give me a call if there's anything we can do to help. Thank you.